All right, welcome to this explainer. Today we're decoding advanced financial accounting. And hey, before you tune out, we aren't just talking about dry math or, balancing a checkbook here. We're looking at the dynamic, constantly evolving language of business growth. We're going to see exactly how companies use it to scale from a tiny, simple idea into a massive global powerhouse. Let's kick things off with a pretty fundamental idea. Accounting is often called the language of business. You've probably heard that classic quote from our source material, but it's literally crucial to understand. When a business is just starting out, basic bookkeeping, yeah, that's completely fine. It's simple. But as that business scales up, as it starts acquiring other companies, opening foreign branches, or going global, well, its language has to rapidly evolve from those simple ledgers into super complex advanced frameworks just to keep up with the sheer reality of its operations. To track that evolution today, here's our roadmap. We'll hit 1, the foundations of accounting, 2, mastering the final accounts, 3, accounting for business growth, 4, mergers and corporate consolidation, and finally, 5, global standards and technology. Let's jump in. Section 1, the foundations of accounting. Because hey, before any business can build a corporate skyscraper, it needs absolute bedrock, building codes. And those codes are these 5 principles. They are the essential laws ensuring financial reliability across the board. First up, the accrual concept. This basically means you record income when it's actually earned, not just when the cash finally hits your bank account months later. Next, consistency. That means sticking to the exact same methods year over year, so your financial history actually makes sense and can be compared. Then there's prudence, basically playing it safe. Never overestimate your profits and always prepare for potential losses. The going concern principle? That simply assumes the business will actually continue operating into the foreseeable future. And finally, the matching concept. This dictates that the expenses of a given period must be perfectly matched with the revenues of that exact same period. That's really what gives us a true picture of profitability. This foundational reliability also heavily relies on exactly how we classify the money we're spending. Think of capital expenditure as your massive, long-term plays, like buying a brand new factory or upgrading heavy machinery. Because they provide value for years, these become assets. On the flip side, revenue expenditure is all about your daily survival, paying the monthly electric bill or buying printer paper. These are short-term benefits charged directly against your profits. Confusing the two, like treating a daily expense like a long-term asset, is literally the fastest way to cause a business's entire financial foundation to crumble. All right, moving to Section 2, mastering the final accounts. This is where we see how all those basic, everyday transactions get summarized into the ultimate business report card. Building that ultimate report card is a sequential 3-step process. Step 1 is the trading account. This is where you determine your gross profit by looking strictly at direct expenses and sales. Step 2 moves that number down to the profit and loss account, where you factor in all those indirect operational expenses, like administrative salaries or office rent, to calculate your true, ultimate net profit. Finally, Step 3 takes us to the balance sheet, which takes a snapshot of the overall financial position and health of the entire company on one specific date. The absolute heartbeat of that balance sheet is the accounting equation. Assets equal liabilities plus capital. It illustrates a really simple but profound truth. Every single penny a business has, every piece of inventory, every delivery van came from somewhere. Either it was borrowed from an outsider, which creates a liability, or it was invested by the owners, creating capital. So what the business owns is always perfectly mathematically balanced against what it owes. But, raw year-end data rarely tells the whole story. You absolutely need adjustments. Outstanding expenses, prepaid rent, provisions for bad debts, these aren't just accounting tricks, no way. They're the fine-tuning tweaks that ensure the final accounts reflect the actual economic reality on the absolute last day of the year, rather than just showing a raw snapshot of cash flow. Let's look a bit closer at one of those crucial fine-tuning adjustments, depreciation, which is specifically governed by Accounting Standard 6. Think of this as the realistic wear and tear tracker. It allocates an asset's original cost over its total useful life, utilizing methods like straight line or written down value. It's incredibly vital because it ensures accurate profit measurement as your assets inevitably age. After all, you wouldn't value a 10-year-old delivery truck the exact same way you'd value a brand new one fresh off the lot, would you? Now for Section 3, accounting for business growth. Because what's really fascinating is what happens to our accounting language when a business starts to aggressively scale and expand. Scaling up immediately shatters simplicity. Suddenly, you might need partnership accounting. meaning you have to meticulously track profit-sharing ratios, interest on capital, and specific partners' salaries just to keep the peace and maintain absolute fairness between the owners. Or consider hire purchase systems. Say you need expensive assets but want to buy them on an installment plan. Well, you don't own them outright yet, so your accounting must carefully track those deferred payments and interest treatments to maintain financial control without completely draining your cash reserves. And this complexity multiplies geographically. Opening a domestic branch requires localized branch accounting to evaluate regional performance, which is tough but manageable. But opening overseas? That introduces foreign branches. Suddenly, your accounting language has to literally translate foreign economies, navigating wildly fluctuating exchange rates and complex currency translations just to report an accurate bottom line back to headquarters. To manage this massive operational growth, businesses get highly creative with leasing. Think of an operating lease as simply renting. It's short-term, kind of like leasing temporary office space, with no transfer of ownership. A financial lease, on the other hand, is a long-term commitment that actually comes with ownership-like benefits over the asset's life. These very distinct accounting treatments show how a growing business intelligently secures its equipment and properties without having to buy absolutely everything upfront. That brings us to Section 4, Mergers and Corporate Consolidation. Our growing business is now transforming into a highly complex corporate empire. Combining two massive companies requires some seriously complex accounting methods. You might use the pooling of interest method, which essentially merges the existing historical book values of both companies together. Or you might use the purchase method, which records the newly acquired company at its current fair market value. Both require precisely valuing all assets and liabilities. This is also where you run complex goodwill calculations, basically accounting for the fact that you often pay way more for a company than its paper value simply because of its brand reputation and loyal customer base. Once you have this sprawling corporate giant with a parent company and multiple subsidiaries, measuring its health requires consolidated financial statements. This combines the financials of the parent and all its subsidiaries. Crucially, though, it eliminates intercompany transactions. Think about it. If subsidiary A sells $1 million worth of goods to subsidiary B, that's not real outside revenue. Consolidation strips away that internal shuffling so stakeholders can look past the smoke and mirrors and see the true, undeniable position of the entire group. At this elite corporate level, we also utilize advanced tools like fair value accounting. Instead of relying purely on historical cost, which is, what you originally paid for an asset maybe a decade or two ago, fair value measures assets and liabilities at their exact current market value today. But there are definitely strict trade-offs to this modern approach. Yes, we gain incredible real-time relevance, ensuring high-level corporate decisions are based on today's actual economic conditions. However, constantly tracking current market value naturally introduces wild market volatility into your otherwise stable financial statements. And honestly, it requires significant, highly trained professional judgment to get those valuations exactly right. Finally, Section 5, Global Standards and Technology. Let's look at how this huge corporate empire actually communicates its financial health on the global stage. Because without absolute uniformity, investors simply couldn't trust the numbers. That's exactly why strict accounting standards exist. In India, for example, frameworks like AS and IND-AS align heavily with global norms, dictating exactly how to uniformly recognize income, measure assets, and disclose information so that the credibility and comparability of those financial statements are absolutely rock solid. Zooming out to the macro level, we have IFRS, the International Financial Reporting Standards, issued by the IASB. Think of this as the ultimate global building code. It allows multinational companies operating in entirely different countries to share a standardized, transparent financial language across borders, making the massive scale of modern globalization possible. And to make this global language actually function at the speed of modern business, we rely entirely on technology. Specifically, XBRL, or Extensible Business Reporting Language. It is a highly advanced digital system for standardizing, sharing, and analyzing financial data globally. It's essentially the digital translation tool that massively improves transparency and allows investors anywhere in the world to instantly download and analyze a company's financial data. Well, we've covered a tremendous amount of ground in this explainer today, tracking the language of business from its basic accrual principles all the way up to complex mergers and digital global reporting standards like XBRL. Advanced accounting really isn't just about compliance. It is the engine that drives better transparency and better decision-making at scale. So I'll leave you with this final provocative thought to ponder. As businesses grow more complex, is your financial language evolving to keep up?